Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X. My guest today is Robert Kientz, a very well-known name when it comes to precious metals and other commodities and other topics. Robert has been covering the precious metal sector since, I believe, 2009, when he published the book Dropshadow, The Truth About the Economy. Did I say it all okay, Rob? Was
Yep, you
it
got it.
2009? Okay. Robert has a great YouTube channel, The Freedom Report, so go and check it out. Robert, that said, welcome to my show. It is great to have you.
Hey, it's awesome to be here. I love your content, by the way. There's so many people now doing this, whereas 5 years ago they weren't. And you do a great job with your interviews and things. So I wanted to fully recommend your channel. I'm having a lot of fun watching your videos.
Thank you. Thank you very much. Let's start with the latest news. Job openings fall to the lowest level since February 2021. Looks like the market shows further signs of cooling off from the hiring boom that followed the US economy reopening after the pandemic. How are you interpreting those results, and what do you expect next?
Well, I think it was in the last year we had 2 quarters of negative GDP. But they weren't consecutive, and the government didn't call a recession. And one of the reasons they didn't call it is because they would look at employment. Well, guess what? Employment's not strong right now. And, I've long been critical of the employment numbers because the way they calculate them. And back when I wrote my book in 2009, chapter 2 is 50 pages, and it talks about government statistics and how they've changed and why they're not maybe as reliable or as clearly defined as they used to be, and it leaves a lot to interpretation. What we're seeing with the jobs numbers is we have a very weak market. I believe we're in recession because if you look at the ADP report for jobs that came out this week, it previews the non-farm payrolls, which will come out tomorrow on Friday. But the ADP was weak. It was a lot weaker in terms of job creation than what we had in previous months. And the job openings have cratered as well. So companies are hiring less and less people are finding jobs. And if you really dig into the employment data, there have been a lot of jobs created the last 3 to 4 years. Overwhelmingly, most of them are part-time jobs, and we have more double job workers. So we have people working 2 part-time jobs, probably with no benefits or a retirement plan, trying to make up for what they made in one job, and their earnings still aren't keeping up. The other thing I want to point out, this is a very complex analysis, so I want to go through a couple points. Wages are not keeping up with inflation. So even though people that have jobs, their ability to purchase goods and services and survive and buy groceries and pay insurance and all that stuff is going down. Plus housing costs are going up because you have rent going up, you have interest rates going up, which makes houses more expensive. So all of this is playing into the fact that consumers are really suffering right now because they don't have the same purchasing power they used to have. We don't have as many full-time job workers. The only jobs that are full-time right now that are getting hired are government jobs. So the government roles are expanding. That's usually not a good sign for the economy, especially in a late stage bull economy when the government's having to spend to create jobs because the money that they're spending, we have to pay later. So it's robbing from Peter to pay Paul. That's sort of an overview of what's going on in the labor market. The last resort, the last thing that the current administration was holding on to say we're not in a recession is now starting to turn over. So I don't know what the excuse would be this time. The other thing I wanted real quick, the last GDP print like a week or 2 ago for the last month was only 1.5%. So essentially we're stagnant right now. We have stagflation. We have inflation, we have higher interest rates, but no growth, and certainly not enough wage growth, and certainly not a strong enough job economy to keep people employed to the level they need to be to buy goods and services to keep the economy where it needs to go. And I think what's going to happen next is you're going to have some sort of crash in the corporate sector. I see trouble ahead with the banking system. I see trouble ahead with corporates who have already been laying off since the first quarter because of this situation. When consumers are 72% of the economy and they can't spend, that eventually works its way to the corporate sector and eventually to the sovereign bond market in the US as well.
Yeah, you actually answered the part of my next question. So red flags all over the market. We agree on that. So what is the next scenario for the equity market? Do we have a danger of market crash in this year already, or maybe that will happen in the next one? What's your take on that?
It depends on your perspective. I'll answer this sort of holistically, and then I'll give an example. So Holistically, the stock market is usually in a fiat-driven economy. Fiat meaning our dollar is not backed by gold anymore, hasn't been since 1971.
Yeah.
We print as much as we want with any theoretical limit. They always raise the debt ceiling. They always print what they need. So there's no theoretical or hard cap to the amount of currency that we can create. And so when you create a lot of currency, but you have less production or slowing production, you got more dollars chasing relatively less goods than you had before in terms of growth rates. And so now the monetary supply is outpacing GDP or production, goods and services. So eventually that will catch up with the stock market. What it does is people actually put their speculative money into the stock market, because if you go back to what I said before, people can't afford things. And so they got to speculate to get returns. And so they'll throw the money into what seems to do the best, and that's the stock market. And a lot of funds invest in stocks, a lot of 401ks and pensions. There's a lot of captured money in the stock market where people can't easily get it out of their 401k or pension, because they got penalties, they got issues that they got to deal with, ramifications, right? So all this captive money from 401k and pensions sitting there, and so it's going to be the last thing to kind of collapse. What you're seeing right now, you've seen problems in the bond market for the last 3 to 4 years. We've had elevated rates. The 2 and the 10-year are hovering between 4.5% and 5% for a while now. That's the danger zone when you have to roll over Treasury debt. So that started to experience some weakness. You've seen real estate now to experience some weakness. Those are 2 of the big 3 investment markets.
Yeah.
Home starts, consumer confidence are going down. Prices are coming down. You're seeing real estate developers say they're going to tiny homes now because people can't afford, the existing. They can't even afford 3-2 homes now, which has been the bread and butter of the real estate economy, the residential real estate market for literally since the 50s, since World War II. That market is starting to come under pressure. The McMansions are coming under pressure. So what you see in the real estate market is a reduction in quality dealing with higher interest rates and prices, and eventually you're going to have a reduction in quantity.
Yeah.
And when that happens, that's going to be the last market to go down before it gets to stocks. It'll get to stocks last, because that's where all that captured money is, and people don't necessarily want to move it unless they have to.
Yeah.
That's holistically. Now, I have some analysts that follow me and some analysts I've interviewed that are more technical traders, Elliott wave analysis or technical charting, that have said they expect the stock market to hit a periodic top here in the summer. Sometime in the summer. People have called it different times, some June, some July, some August. But they're expecting weakness going into the fall in the stock market. Part of that's due cyclically, because the summer tends to be you park your money and you go have your vacations. With less people vacationing, I still think that we're going to have the typical weakness in the stocks in the summer, but I think it's more than that. I think it's structural and fundamental. And we don't know whether this is the big crash. There are some technical chartists that say this is the 5th stage and we're going to have the big crash. Some say it's 3rd, it's intermediate. But everybody seems to agree that the stock market's probably going to pull back here. It'll be interesting to see, because all of this is fed by money creation. Who does that? The Fed, the central bank. We're in an election year, and that's the big potential difference this year. Typically, the Fed wants to uphold the markets during the presidential election. If they're able to do that and they ease a little bit more, and they don't tighten, but they ease a little bit and they make conditions more dovish, then perhaps the stock market doesn't correct as much. We'll have to see what happens. An election year is a little wonky because you get that sort of election dynamic where the Fed's trying to support the system. But I honestly, in the long run, and this may be a question you were going to ask later, but I'll go ahead and answer it. In the long run, the Fed's between a rock and a hard place. Inflation is stubborn. They can't cut. They're already backing off on their promised 3 rate cuts. We don't know if we're going to get any rate cuts this year. I suspect at least 1 leading up to the election.
Yeah.
But they can't go too far back because inflation is sticky. In a stagflationary environment where you don't have wages going up, you don't have jobs going up, it's really hard, to hike rates. But at the same time, you've got higher interest rates and inflation. So whatever they do, it seems like it's going to make the problem worse, whichever way they go. That's why I say they're stuck between a rock and a hard place. Yeah. And I don't know if we'll get that typical boost we do in the economy before the election this year. And I think that's why the technical traders are expecting a rollover sometime during the summer. How far of a rollover? Honestly, I need to see what happens with the banking sector. I need to see what happens with the geopolitical situation, and I need to see what happens with bonds. Those are my 3 triggers for calling, a top in the stock market and an extended recession.
Okay, let's how can average investor, not average investor, how can average man on the street protect himself against that? What should one do to protect his wealth?
So in my opinion, what I do, first, you got to pay debt off. I'm a big gold, silver guy, and I'll get to that in a minute.
Yeah.
You have to pay debt off because you don't want to have any high interest rate debt. And if you were to lose your job or a reduction in income or inflation just goes crazy, your ability to meet obligations with a declining value of the dollar is going to be an issue. And I would say even before you go buy an investment like gold, silver, or even Bitcoin, or whatever you think is going to get you through this turbulent time, to me, I pay debt first. So I'm almost completely debt free. I got a little
Agreed.
smidgen left of really low interest rate debt, which I'm slowly paying off. And once I get completely debt free, I will have no mortgage. I'll have none of that stuff. I'm going to be very nimble as to what happens. So even if I were to lose job income or lose business income, I can navigate that. The second thing is have a bucket of cash. And people are like, why cash in the declining of the dollar phase? I think the dollar eventually is going to end in the next couple of years in terms of its current, paper format. I think they're going to go to an electronic version. But there's going to be a big issue when that happens. It's going to crash at some point. So Rob, why have cash? Because cash is always king until it's not. And even if you see the dollar plummet by 20 points on the dollar index, people are still going to take cash until it's obvious that it's become worthless, which all fiat currencies eventually get to eventually. So have a little bucket of cash, and it's emergency money, because if we start having major economic problems, if you need gas, they're going to take cash before gold and silver or before Bitcoin or before you're bartering your chicken eggs or whatever, if we ever get into that. So have a bucket of cash. And then third, go into investments that you think are going to hold value and are easily liquidatable. If you look at a simple strategy with precious metals, silver will be your spending money, especially constitutional pre-1964 issued US coins, or like a US Eagle or a Canadian Maple Leaf, an ounce of modern silver. That's easily barterable, regardless of what the price goes to in silver. And then gold would be your longer term sort of disaster insurance, if you will, that will hold value over time. And by the way, gold has beaten the stock market indices and bonds and most sectors of real estate since 2000. And a lot of people don't know that. And especially since we're sitting near all-time highs in gold, we've hit 3 new all-time highs in the last 3 to 4 months. It was, we crashed through 1900 in 2020. Then we crashed through 2000, 2100, all the way to 24 something this year. Silver's now sitting at 30, which is the Maginot line for silver. Once it goes above 30, that's a signal that you're getting ready for a big silver run. And so what we need is just a monthly close above 30 in silver. And once that happens, precious metals will be in their next bull market phase. So that might be a way. Some people are crypto oriented. They want Ethereum or Monero, or they want Bitcoin, or, whatever the case may be. And if that's your flavor, whatever your disaster insurance is, go into that. But I always say, try to get your debt down, especially high interest rate debt down first, to allow yourself flexibility and allow yourself to become more personally liquid in your personal finance situation. Have some cash for emergencies, but spend it when you think it's going away. And then beyond that, your longer term sort of insurance types of investments. I'll also throw farmland in there. The only thing that outperformed gold and silver during the Great Depression was productive farm or ranch land. So if it can grow food or you can raise animals on it over a 5 to 10 year period during recessions, that's probably the best yielding investment. It's less liquid than like Bitcoin or gold, but it does give you an option for long-term savings if you can afford that, because they're not making any more land. You can see how much immigration we're getting. You can see that we have, a food scarcity issues. So for me, I think that raw, arable, ranchable land is going to be extremely valuable the next 10 to 20 years.
Very smart. You said one interesting thing, and that is you believe the dollar will be in the future in some form of electronic version. Does that mean that monetary system will not collapse, but it will change?
Yeah, this is going to be really interesting. Typically, during a currency reset, they reset to gold to issue a new currency. Maybe then go back to a gold standard. This is the first time in human history 99% of the whole world has been on a pure fiat system. This is an experiment we've never done before. This is not Bretton Woods in the 40s after World War II. This is a completely different animal. And all currencies are coming under inflationary pressure. You've seen issues in Chile. You've seen issues in Turkey. You've seen issues in Zimbabwe, which Zimbabwe now has a gold-backed digital version of currency to try to stabilize their system, and it's working. You've seen problems in Argentina, which led to them getting a libertarian president, which is now cutting government everywhere and getting them fiscally responsible for the first time in, what has it been, 3 decades in Argentina. They've just had, 3 decades of the IMF having to constantly bail them out in currency crisis, and they're finally seem to be getting their stuff together. So you can see in those nations where their currency has already collapsed, the changes that they're trying to make. The Saudis, for example, are energizing all of their existing industry to go mine materials because they know that oil is going to run out eventually. They know that their dollar and bond investments are not going to hold value. So when I was speaking at PDAC, the world's largest mining conference in Canada earlier this year, I was talking to a Saudi company and they're saying, yeah, the government is promoting us mining for minerals and building a labor-based, production-based economy. It's not just that they're going to dig gold, silver, tin, lead, and copper out of the ground to replace the oil. It's that they're energizing their workforce to be a what? A manufacturing and a production-based economy. They know that the days of the oil and buying the US bonds and that whole petrodollar thing is over. So that's essentially what's going on. Now into the digital version. I gave this lecture at PDAC and I have videos up on my YouTube if anybody wants to watch. The BIS, IMF, and most of the world's central banks are in a new central bank digital currency system. They've been working on mBridge and all of these various projects. You can see all of this at the BIS.org website. Just go to BIS.org and look for their section on projects. Most of their projects that they're running right now are projects around development of central bank digital currencies. And it gets really complicated, but I'll say it like this: 2 tiers, wholesale, retail. Wholesale is country to country or central bank to central bank. Retail is person to person or person to business. It allows them to have a hyperinflation on retail and reset it without killing the central bank. So they're building a layer of protection in that they didn't have with the pure fiat era, which it also will stop any one currency from being the world dominant currency. We're moving into an era of many competing currencies. The entire system will be backed, we expect, 40% by gold. That's Project Aurum. 40% gold, regardless of where it is. So that will back up this system. That's why since 2010, central banks have bought more gold than at any time in history. A lot of people don't know this. The central banks of the world have recapitalized their balance sheets with more gold purchases than at any time in human history because of Basel III requirements and because of the CBDC system, which is going to put gold as a high quality liquid asset, one of the top 3 in the system to stabilize it. The central bank digital currencies, there are over 138 projects going right now at various stages. So almost the entire world is moving to this system. You can see that on the Atlantic Council website. They have a graphic up there telling you the stages of development. The US Fed, our central bank, has previously denied being involved, but if you go to the BIS's website, their name is on several of these projects. The New York Fed, in particular, their technology division has been working with all the other world central banks, the BIS, IMF, in development of this system. So that is the next system. And world leaders have come out at all the UN, at the G20 meetings, in the press, as saying central bank digital currencies are the next system. So they've already got the solution to the failure of the fiat system. The problem is there's a danger with the central bank digital currency system is they can push button affect your bank account. So the way that they've designed it and the way the white papers are written by the IMF, they need to control aggregate money supply. This is Keynesianism on steroids. This is modern monetary theory. They don't care about the individual. They care about the system and how much flow of money there is. And in a purely fiat system, if you don't control the flow of money, you have hyperinflations and you have riots. And they don't want that. The ruling class doesn't want to lose their power. So part of this is for the ruling class to keep their power. Part of it's for stability. But what they can do is they can say, we need a 20% inflation rate to get rid of all this cash. They literally push a button and your bank account just goes down by 20%, the valuation.
Yeah.
And that's kind of a dangerous system because you can't get out of it. And the only way really to get out of it is to get out of that system and maybe have cryptocurrencies or gold, silver, or other things that are outside of that digital system. The other part of it is we expect that they're going to implement social control systems. They've already got this running in China, where if you don't do certain things, they can prevent you from getting on the bus or withdrawing money or paying your electric bill, or the ability to travel out 15-mile area, your car before getting pulled over. So the concern is that as the rest of the world central banks go to this system, they'll also implement a lot of these social controls because a lot of the world's leaders believe that there's a 2-tier system. It's almost like a caste system. There's the rulers and the ruled. And a lot of their rhetoric is around, we need to make sure that we're putting all this structure in place to keep the people from doing things we don't want. It's not the people are free and they elect their government and the government serves them. It's the government is now entrenched as this bureaucracy, and they're now telling the people what they should be doing. And the central bank digital currencies, along with social credit, along with advancements in our mobile tech networks, would allow them control over the entire economy. And that's what the Keynesians have always wanted. They just never had a system for it. They had the old dollar bond system, which is very imperfect. But now they're like, forget this, we're going to go digital, and we're going to build all these bumpers and safeguards into it, and we're going to pull all the levers of the economy. It would be what Lenin and Stalin and all those guys in the Soviet Union always wanted, the ability to pull a lever and completely control everything in the economy. And that's really the dangerous side of it. We don't want that here in the US because we have a constitution, law of the Western world, you know, kind of looking at that saying, is that what we want? But most people don't know what's going on because they're not talking about it on mainstream media. So they don't know what's going on. So I think the system will be the alternative presented whenever we do have the end of the dollar and we're having this big economic sort of crash. And then I would just implore people to go learn about the CBDCs and decide for yourself, is that a system that you want to be under? Or would you like to go back to maybe a gold-based system or an asset-backed digital currency, you know, a digital currency with actual asset backing like gold, silver, oil, whatever? You know, there are different options, and I think we need to have a discussion in the Western world about what the people want. And so far, the bureaucrats haven't asked us. I guess that's the big problem.
Yeah, I tend to agree with majority of things you said over here, but one thing puzzles me, and that is why silver in these circumstances, in this series of events that are coming, they are coming. It's not an if question, it's a when question. So why is silver not at $100?
Well, that's a really complicated question. That
I know the manipulation part. You probably, yeah.
I'll
For an
give you the
average investor,
simple-
explain, please, the manipulation part and answer my question, please.
So let's do like a high-level overview. Since 1974, with one of the Commodities Acts, which established trading of commodities in the U.S. under a central, it used to be kind of regional, and it was a little bit more manual, and you had markets. And there were problems like Jerry Markham, which was a law professor, also an avid researcher. I think he was at Florida University.
Yeah.
He has a whole bibliography of work around the commodity sector. One of his reports talked about the problems with the commodity sector up until 1974. So they passed legislation. They created the Commodities Future Trading Commission, which is the regulator, the government regulator of the markets. They created the markets, and now on COMEX and NYMEX and, you know, back east, as they say, in the upper Northeast. And so they trade, you know, where the stock markets and stuff trade, but it's commodities market. The problem is that they wanted to smooth out the price variations and things like farmers selling their crops and taking losses. So they offered paper derivatives or paper trading as a way to offset that as insurance. The problem was that the market participants came in and said, I don't have anything to hedge, but I want to trade anyway. And it became a gambling casino. So literally, you can go to the commodities markets and buy more paper contracts representing more goods that are ever produced in a year, and you can trade it 500 times in one day. You literally could trade 1,000 times the amount of any commodity in a year in a day if you wanted to. And what that's led to is a lot of speculation. Now, the second step is gold and silver are both barometers for the health of the dollar. So there is an incentive for the U.S. government, which is based, you know, our currency is based on the dollar, to not allow gold and silver to go too high. So there have been some circuit breakers put in. Case in point, a couple of years ago, Rostin Benham, who was then the acting chairman of the CFTC, now the elected chairman, came out at a Boca V conference, a commodities conference. This is on YouTube, it's public. And I've covered this many times, and said, 3 years ago when we had silver squeeze and people were buying a lot of SLV and younger millennial investors getting interested in silver and driving that up, much like they did to GameStop and AMC, they went to the silver market and they were doing it through SLV. It drove silver price to $30, and Rostin came out and said, as the regulator, they capped the price at $30. They did it through margin requirements. They put circuit breakers on the market. They did all these things, and he elaborated on all the tools. He literally gave the game plan and said, we did this on purpose. And when the commenter asked him why he did it, he said, well, the market was running so fast, the market participants, it was going to damage. And what do you mean by market participants? Well, look at who trades on that market. It's not mom and pop, me and you.
Yeah.
It's not homemaker Sally. They can afford it. It's the big guys. It's the miners and the banks and the speculators and the financial houses and the super rich. And so that market didn't want a higher silver price. Why? Silver's used in everything. It's used in the military. It's used in every aspect of science. It's used in computers and iPhones. Without silver, we could not have a modern economy. because the only thing that can conduct electricity and do the things it does is gold, and gold is about 80 to 90 times more expensive. The modern economy wouldn't work the same without silver. So they had to protect silver, and they had to protect the market for silver and keep it in a range, so that the goal was to make sure that we had easily addressable silver and it was cheap enough to run the economy. And also they didn't want silver popping, because then you would have all of the anti-dollar, or, you know, the stacker crowd, the prepper crowd, all those crowds coming in just buying a ton of metals. And that could cause a run. It would be like a metals run instead of a bank run. But it would be the opposite. It wouldn't be the failure of the gold and silver market. It would explode the gold and silver market, sort of what happened in 2008, 2011. So they were kind of trying to put a bumper around that too, because that potentially could damage the dollar and it could potentially damage the economy. And they weren't ready. They didn't have the CBDCs ready. They didn't have solutions ready. So they had to kind of cap it. So a lot of the commodities markets, including sugar and oil, platinum, palladium, gold, silver, they're all controlled. They're done that way for the purpose of liquidity of the market, but also to protect, especially the precious metals, them from getting too frothy. Even though that's the case, however, silver recently blew through 30, gold blew through 2,400, made 3 new all-time highs, because now we got the rest of the world coming in and using, like HSBC, one of the big 4 banks that trades gold and silver market, and that has a concentrated position in it, is actually owned essentially by China. And so you have other countries in our markets that are now taking gobs of metal off the markets. And now we're starting to run into a theoretical shortage on silver. Last 4.5 years, the silver mines have not put out the same amount of silver we're actually physically demanding and using. So our world stockpiles all across the world are drifting down. And eventually that's why the market started to pop. So what you have essentially, we had a controlled market, the US and London, the LBMA controlled that market. That control is now eventually moving east to China and to Dubai and those alternative markets, Russia. And the metal is also flowing there. And the system that we have now that set that market is now falling apart. And that market's been in place dating back to the old British Empire, you know, hundreds of years. But that system is changing. And so I think the dynamics for gold and silver are going to change significantly, because no longer is the Western derivatives complex controlling that trade as much as it used to. So things are really starting to shift there. So I think we're going to see a lot more people buying physical silver. It hasn't happened in the US yet, because US discretionary consumer income is down. But if we get into any sort of banking panic or recession, I expect US consumers to buy as much gold and silver, especially silver because it's cheaper, it's the poor man's gold, as they can carry home with them. And they're going to sell bonds, they're going to sell their cars, they're going to sell real estate, they're going to sell stocks. And that's where you're going to get that cycle valuation out of those bubble assets into the precious metals and things as well, like Bitcoin, Dogecoin, you know, the cryptos as well.
Yeah, we covered physical, but what's your take on silver equities? Are they a good buy right now?
You know, I kind of think so if you're a long-term holder. The caveat I always make to this is be super careful with the gold and silver equities market. It's a relatively thin market when everything else is doing well. So what do I mean by that? Since we came out of the Great Recession the last 14 years, and we've had a fairly decent economy, mostly through money printing, people will rotate into traditional American investments. That would be stocks, bonds, real estate, other things like that, businesses. You know, we're very entrepreneurial, and those are our standard. However, those markets are very young compared with precious metal. Precious metal has been around for 5,000 years across the world, not only as money, but considered as savings assets as well. I still consider them money. A lot of people consider them commodities or savings assets, but that's a 5,000-year-old market. And whenever the economy runs into trouble, gold and silver does well. Now, even though silver went to 32 and is trading at 30 something right now, and gold's mid 2300s and got up to like 2460 at one point, the mining indexes are not doing terribly well. I'm looking at the GDX, which is the Van Eck gold miners. That's the big mids and the mid majors and majors. It did have a nice little pop since 2020. The trading range has gone up from what it was between, you know, the last financial crisis, 2013 and 2020. Why? Well, in 2020, we had the government shutdown. Gold and silver went up. What happens to the equities? They go up. Because when gold and silver prices go up, if you're a producer, you can make money. So we had a nice little pop in GDX. It didn't last. This year, we've had a nice little increase in GDX in the bigs, gold and silvers, but it's never recovered even to 2020, much less to 2011 when we were hitting like all-time highs in that index. Now, if you go to the juniors, it's more bleak. The juniors have been sitting in a trading range all the way back to the last financial crisis. They started crashing down in 2011. They reached a small little peak in between 2012 and 2013, about midway through, and then they've crashed down to this range ever since. They're not recovering. So I made the rounds this week. Well, I made the rounds in March at PDAC in Toronto and talked about 35 companies, both majors and juniors. And then the last week or so, myself and a friend of mine, who we help with social media, help raise money for these companies. We've been talking to a lot of executives, and the junior market, the explorers, many of them are on the verge of absolute bankruptcy. They cannot raise money at current stock valuations without diluting their stock. If they dilute the stock too much, the investors flee. And they don't want to raise debt service because they don't have enough income to pay the interest payments. And they can get streaming and royalty deals, which is a third party like Franco-Nevada or Wheaton Precious Metals could invest money, and the reason they'll invest money in these companies is because when they go to production, they get the metals for pennies on the dollar. So it's a boon for these royalty and streaming companies. They're acting like an industry bank for the miners, but they've even started to invest a little bit less money because some of these projects aren't coming to fruition. When you had silver in particular trading in a range between like 18 and 22, none of the junior miners or even most of the majors couldn't make money. So a lot of the majors shut down mines. That's why you had the lack of mine production, and that's why you had the above ground silver stockpiles drain, because a lot of mines went on care and maintenance in Mexico and Peru, some of these big districts, the US, Australia. The gold miners were, making decent money because at 1,300 was their cost on average, maybe 14 if you're high cost. Well, gold price has been above that for a long time, since basically 2016, 2017, when it started to rise. So we've had 4 or 5 good years in gold, but in silver, it's been an abomination. So what's happened is a lot of these mines have gone on care and maintenance, and the index, the junior index in particular, is flatlined. There's not a belief in the US. When I was talking to companies, they're like, it must be discretionary income for US households because they're not buying stock. The amount of US households not buying equities in the gold and silver space is astounding given their prices, especially the gold companies who are making money hand over fist. Their balance sheets are very healthy. They cut debt. They stopped diluting. Some of them actually bought back shares. Some are doing dividends, which is hard in the precious metals industry, but they're not getting that share price increase. And when they're reaching out via social media, conferences, mass media, they're not getting a response. And so a couple of executives I talked to this week thought that the consumers were just done. They had no discretionary income. So what that means is even though the metals prices are up, a lot of mines still on care and maintenance. The junior mining sector is ripe for takeover, mergers and acquisition, and bankruptcy. And you also have dynamics like a very far left president in Mexico, who wouldn't surprise me if they put a lot of anti-expansion in the mining sector policies in place, and even potentially at some point nationalize the mines. What I see happening medium to long term, 5 to 10 years, is that we're going to run so much out of silver that people are going to be so desperate to get it out of the ground that I think countries are going to start nationalizing some of those mines. And it's become an emergency thing because silver is so important. It's the most critical mineral on Earth right now. There's no other mineral that's as critical as silver. So right now, the state of the industry is we're in the desert with no water. But you can see sort of that oasis on the horizon, and eventually we'll get to the point where a ton of money comes in. But this time around, unlike 2009 through 2011, the equities are not following the metals. And mostly it's because US and Canadian consumers don't have money to buy them. They're just flat broke.
Yeah.
And so what's going to have to happen for those miners to break is you're going to have a major issue in the economy to where people sell their real estate, sell their bonds, sell their S&P 500 and go into the mining sector.
Yeah. Do you have some projections of performance of silver price, let's say in next 2 years? Do you have your own projections?
Well, if what goes down the economy, I started saying this about the third quarter last year, 2024 is going to be the start of a very volatile economy because we have instability in our currency, we have too much debt, wages aren't keeping, all of the things we've been talking about led to an unstable economy. Yeah. And during that period, before you have a recession, you have a lot of volatility. We're seeing volatility in the markets. We're seeing a drop in consumer sentiment. We're seeing issues with savings. We're seeing issues with jobs. And that's going to cause asset price valuations to to swing up and down,
Yeah.
especially bonds, because bond investors are smarter than stock investors, no offense, but they do more research, and bonds, that type of investment has the smartest people in it. It's a huge market, especially you've got sovereigns in there. You've got very wealthy financial houses that buy bonds. Bonds were considered good as cash. I don't know if they're considered that anymore. Interest rates rising puts tremendous pressure. So something's going to break in the economy in the next year to 18 months. And I feel like a broken record because I've been talking about this forever. But I think we're literally down to the 11th hour and the 30th minute, you know, historically speaking, if you look at 100 years. So we're at the point at which any point in time, the next bank failure could be the domino that sets it all off. Or any sort of, even if it's not the US, maybe another major currency goes belly up or somebody defaults on their debt. You know, maybe it's not Zimbabwe this time. Maybe it's a big country. Maybe it's Greece. Maybe it's Spain or Italy. You know, those troubled European countries. Maybe it's Brazil. Maybe it's Venezuela. Maybe it's Chile. You know, maybe it's Canada. We don't know. But those problems are going to start a cascade across world financial markets. They're all interconnected. It's very incestuous. There is so much what they call direct financial investment from one country to another and from one bank to another, that once one of these big countries pops, the rest are going to do it. Yeah. And when that happens, I think gold and silver just launch, and we're going to see prices you've never seen before. We've already seen it in gold. We hit 2460. That was $450 more than the price in 2011 and about $300 more than the price in 2020. And silver hasn't broken all new all-time highs, but it's broken a 40-year trading range dating back to the 80s, late 70s. So you've already seen silver break a 40-year trading range, and it stayed there for a little while. It stayed there. It stayed above 27, 28 bucks for a while. So I think you're seeing some appreciation across the world for precious metals. That eventually, when you have that last domino to fall, the stock market, I think is when you see gold and silver just go bonkers. I think they'll steadily increase like on a stair-step fashion until then. But when you see that US stock market start to roll over, you're going to see them go to like what we call a hockey stick. And you're going to start seeing more straight moves up. We did see a straight move up in silver a couple of weeks ago when it broke 30. And it went like this for a while. And then it kind of, you know, you're starting to see that impetus in the metals markets where the longs are overpowering the shorts. Yeah. And it's not just in the US, it's around the world. So as the situation gets worse, people are going to start piling in. You've also seen Bitcoin pop. Bitcoin almost hit its all-time high again in the 70s. It kind of cratered out at that high 60s, 70-ish. It hasn't made really new all-time highs in a bit, but I think the cryptocurrency is going to get a lot of investment as well. I think you're going to see huge, I mean, Bitcoin 100, 200,000 wouldn't surprise me, given especially the millennials. By population, the largest generation across the world, and they're very in tune with cryptos. So I think you're going to see a lot of investment in cryptos as well.
Okay, final question. What happens with other commodities in those bad times, so to say? Let's say copper, uranium, lithium. What happens with them?
Well, that's a good question. So I'd say typically in a deflationary economy, when you get a deep recession, especially a worldwide one, which every analyst, even the big banks are saying, yeah, when it comes this time, it's worldwide. It's not just US or Europe, it's everywhere. So when you see that, you'll have deflation. You'll have less demand for things like tin, lead, zinc, copper, the rare earths, that kind of stuff. However, and so I think those indexes could come down. I think copper will come off its all-time highs that it's been, you know, trying to trade through for a while. And I think you'll have some softness in the intermediate term. But whenever the world gets back to growth, copper in particular, lithium, uranium are going to absolutely go nuts. So on the other side of this recession, some of the and silver will as well, because it's very commoditized. It's used in everything. It's not just money anymore. Those key, you know, rare earth elements, those key sectors of commodities are going to go bonkers. Iron will go bonkers. Oil will go bonkers. Natural gas will go through the roof because those are energy metals. And you saw what happened in 2020. We had shutdowns and then we opened back up and it's like the commodities complex went, whoop, you know, and that was just a restart of the economy. If we have demand and supply destruction and we come on the other side of the recession, Katie bar the door, you know, famous Texas saying, it's going to go nuts. Now, there will be that surprise. Look at what happened in nickel in World War II. We stopped putting as much nickel in our nickels. We actually started putting silver into the only time that we ever had silver in our nickels was 42 to 45 in the war because nickel was silver wouldn't commoditize then. It was money. And so they needed nickel for the war effort. So they started taking nickels out of nickels and put silver in there. So something's going to happen like that people aren't counting on. One of these commodities is going to go straight vertical, whether it be nickel or silver. Maybe it's oil this time. One of these commodities is to stand above the rest. And it's going to be something that we look back on and say, oh man, I wish I'd thought of that. You know, because this happened, we ran into a shortage of that. I'm guessing probably copper, probably silver would be my two leading candidates, but look at oil, look at natural gas. Some of those could outperform. Look at things like hog futures and food. Food-based commodities are going to go through the roof as well, because if we get into a situation where we either have a lot of war or even a general economic demise, people are going to need to eat, and all their discretionary income is going to go to food. So I think you'll see a spike in the food commodities as well.
Good point, Robert. That was Robert Kientz. Thank you, Robert, for coming to my show. It was a great chat, as I expected, and I hope I will see you soon again in my show. Thank you very much.
It was an absolute pleasure. Thank you so much for inviting me.